This book, One Up on Wall Street, written by Peter Lynch, is the most practical investment book. The book consists of 3 sections. First, an introduction to investing and development of an investor mind. Second, step-by-step process to pick stocks. And third, long-term view to investing and portfolio. Whether you invest in stock or thinking to become an investor, this is a must-read book. Peter Lynch was the manager of the Magellan Fund at Fidelity Investments between 1977 and 1990. His average annual return was 29.2%, making it the best-performing mutual fund in the world. Chapter 1. The Making of a Stock Picker. Distrust in the stock market was a prevailing attitude not only in America throughout the 1950s and 1960s, but also in Peter Lynch's family and relatives. Almost everyone advised him to stay away from the stock market. Peter got his first job as a caddy in a golf course where he would hear presidents and CEOs talking about their triumphant investments, which made him rethink his family position that the stock market is a place to lose money. He continued to caddy throughout high school and into Boston College, where he, along with history, psychology, and political science, studied metaphysics, epistemology, logic, religion, and the philosophy of the ancient Greek. Peter bought his first stock in 1963, which increased by 5-fold in less than 2 years, which later helped him to pay for his graduate school award. During his senior year at Boston, he got a summer internship at Fidelity, which was the best-performing investment house at the time. He was put to researching and writing reports and visiting companies, the same as regular analysts. Chapter 2. The Wall Street Oxymorons. Individual and amateur investors have an edge on most professional and institutional investors. In most cases, professional institutional/fund managers are restrained by cultural, legal, and social barriers. Many are held back by various written rules and regulations. Some bank trust departments simply won't allow the buying stock in any companies/unions. Others won't invest in non-growth industries or in specific industry groups, such as electric utilities or oil or steel. Some funds are further restricted with a market capitalization rule. They don't own a stock in any company below, say, a $100 million size. Size is measured by multiplying the number of outstanding shares by the stock price. But there are some handful of fund managers/investors with a little or no restrictions, including John Templeton, Warren Buffett, Peter Lynch, to name a few who have had a long, successful track record. Under the current system, for many large institutional/professional investors, a stock isn't truly attractive until it is widely known, and a number of large institutions have recognized its suitability, and an equal number of respected Wall Street analysts have put it on the recommended list. For e.g., many pension funds are allowed to buy from a pre-approved list of stocks only. Chapter 3. Is this gambling or what? Understanding the difference between investing in debt and investing in stocks or companies is important. Investing in bonds, money markets, or CDs are all different forms of debt, for which one is paid interest. Historically, debt instruments have recorded less than 5% gains. In bonds, you're nothing more than the nearest source of spare change. When you lend money to somebody, the best you can hope for is to get it back, plus interest. Investing in stocks is undeniably more profitable than investing in debt. Since 1927, common stocks have recorded gains of 9.8% a year on average. Investing in stock has unlimited upside as you are a partner in a prosperous and expanding business. Stocks are riskier than bonds. There are a multitude of companies that have disappeared from the list. Fortune of a company changes. There is no assurance that major companies won't become minor. Buy the right stock at the wrong time and at the wrong price, you will suffer huge losses. Investing in bonds is not completely without risk. For example, when interest rates rise, the price of the bond decreases. Hence, you either accept low interest or sell your bond at a substantial discount to face value. Unfortunately, investing in stocks is still considered gambling by many. It is gambling if you don't know what you are doing and if you don't have the skill and dedication. Chapter 4. Passing the Mirror Test. Before you buy a share of any company, There are 3 personal issues that ought to be addressed. 1. Do I own a house? 2. Do I need the money? And 3. Do I have the personal qualities that will bring me success in stocks? 1. Do I own a house? Before you do invest in stocks, you ought to consider buying a house. Buying a house is a much better investment for most people as they are likely to hold for many several. It is a good hedge against inflation. Also, it gives you a roof over your head and a sense of permanence where you can live for many years. 2. Do I need the money? The money you want to invest in stocks should be truly surplus. For instance, if you're going to have to pay for a child's college education in 2 or 3 years, don't put that money into stocks. 3. Do I have the personal qualities it takes to succeed? The qualities required are patience, self-reliance, common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, an equal willingness to admit to mistakes, and the ability to ignore general panic. The good news I can tell you is that to be a great investor, you don't have to have a terrific IQ. If you've got 160 IQ, sell 30 points to somebody else because you won't need it in investing. What you do need is the right temperament. You need to be able to detach yourself from the views of others or the opinions of others. Warren Buffett. It is also crucial to be able to resist human nature and your gut feeling. Don't try to time things that are beyond your control, i.e. interest rate, stock prices in short-term, monetary policy, etc. Chapter 5. Is this a good market? Please don't ask. Invest in companies, not in stock market. Never should you ask, is this a good market to invest? Thousands of professionals, including technical analysts, gold experts, macroeconomists, and forecasters try to predict market, recession, boom and bust, inflation, interest rate, central bank's policy, etc., but they haven't been able to with any useful consistency. Chapter 6. Stalking the 10-bagger. The best place to start looking for the 10-bagger is close to your home. You just need to keep your eyes and mind open. You come across many different companies at shopping malls, workplace, medical test office, etc. You didn't have to work at Kodak to know that the new generation of inexpensive, easy-to-use, high-quality cameras will turn the photo industry around. Maybe you work at school and come across a company that is automating the attendance system at school and thus will save hundreds of teachers' hours. That company is worth researching. It is important that you invest in companies you are able to understand well, and that will give you an edge. A doctor is well positioned to understand companies in the health industry, including pharmaceuticals. The person with the edge is always in a position to outguess the person without an edge. If you're in the business or industry, you have a double edge as you will know the customer liking as well when not to buy a particular company. Invest in things you know about. Chapter 7. I've got it. What is it? What you have got in the last chapter is simply a lead to a story that has to be developed. Just because Dunkin' Donut is crowded doesn't mean you own it. What's the bottom line? If you think a company's product is going to grow significantly, then the question is what percentage of revenue or net income that product accounts for. For companies like Procter & Gamble, Pampers may be a fast-growing product, but its impact on the company's bottom may be too small. Big companies, small moves. The bigger the company, the harder it is to keep the percentage of growth constant or increasing. The 6 categories. Once you have established the size of the company relative to others in a particular industry, you can place it in one of the 6 general categories. Slow growers, stalwarts, fast growers, cyclical, asset plays, and turnaround. 3 of the above 6 categories have to do with growth stocks. You can separate the growth stock into slow growers, sluggish, medium growers, stalwarts, and then the fast growers, the super stocks that deserve the most attention. Growth companies tend to expand in more sales, more production, and more profits in each successive year. 2. The stalwarts. These are multi-billion companies that are expected to grow faster than slow growers. The stalwarts have been good performers, but not the star performers. 10 to 12% annual growth in earnings is expected from the stalwarts. Depending on what you buy and what price, you can make a sizable profit in stalwarts. Companies in this category offer good protection during recessions and hard times. For example, people will continue to eat cornflakes during recession, and thus Kellogg will grow steadily. 3. The fast growers. These are small, aggressive new enterprises that grow at 20 to 25% a year. Big winners in the stock market, as long as they can keep up the growth. With a small portfolio, one or two of these can make a career. A fast-growing company doesn't necessarily have to be in the fast-growing industry. Risk in fast growers is overzealous and underfinanced young companies. 4. The cyclicals. In a cyclical industry, companies' sales and profits are expanding and contracting regularly. The autos and the airlines, the tire companies, steel companies, and chemical companies are all cyclicals. When the economy is expanding, the cyclicals companies are flourishing, and their stock prices tend to rise much faster than the process of stalwarts. When the economy contracts, their sales and profits go down faster, and thus the stock price. When bought at the wrong part of the economic cycle, it may be years before you'll see another upswing. 5. Turnarounds. Turnaround candidates have been battered, depressed, and go so far down in a down cycle that people think it would never come back again. A poorly managed cyclical is always a potential candidate. Majority of turnarounds fail, but the occasional major success makes the turnaround business very exciting and very rewarding overall. Investors must stay away from the tragedies where the outcome is unmeasurable. Turnarounds that are likely to be successful are the ones that focus on its core business and get out of other businesses they enter to diversify business. 6. The asset plays. An asset play is any company that is sitting on something valuable that you have known about, but the crown has overlooked. The asset play is where the local edge can be used to greatest advantage. In short, you're looking for a business with assets, whether it's cash, investments, properties, machines, etc., that is worth more than the price you will pay for the stock. Companies don't stay in the same category forever. High-growth companies cannot maintain the double-digit growth forever. Fast-growing companies will become stalwarts and slow growers, and may go so far down that they become a turnaround candidate. Putting stocks in categories is the first step in developing the story so that you know the kind of story it's supposed to be. The next step is filling in the details. Chapter 8. The perfect stock, what a deal. It's much easier to develop a company if its business is simpler and thus easier to understand. The following 13 attributes will make it easy for you to find the company. 1. IT sounds dull, or even better, ridiculous. The perfect stock would be attached to the perfect company, and the perfect company has to be engaged in a perfectly simple business, and the perfectly simple business ought to have a perfectly boring name. The more boring it is, the better. 2. IT does something dull. I get even more excited when a company with a boring name also does something boring. A company that does boring things is almost as good as a company that has a boring name, and both together is terrific. Both together is guaranteed to keep the oxymorons away until finally good news compels them to buy in, thus sending the stock price even higher. 3. IT does something disagreeable. Better than boring alone is a stock that's boring and disgusting at the same time. Something that makes people shrug, retch, or turn away in disgust is ideal. 4. It's a spin-off. Spin-offs of divisions or parts of companies into separate, freestanding entities, such as Safety Clean out of Chicago Rawhide or Toys R Us out of interstate department stores, often result in astoundingly lucrative investments. A large parent company doesn't want its spin-off to get into trouble as it reflects poorly on the parent company. Hence, spin-off usually gets independence with a strong balance sheet. Spin-offs normally have strong balance sheets and are well prepared to succeed as independent entities. And once these companies are granted their independence, the new management, free to run its own show, can cut costs and take creative measures that improve the near-term and longer-term companies. 5. The institutions don't own it, and the analysts don't follow it. If you find a stock with little or no institutional ownership, you've found a potential winner. Find a company that no analyst has even visited or that no analyst would admit knowing about, and you have got a double winner. 6. The rumors abound. It's involved with toxic waste or the mafia. A company surrounded by rumors trades at a steep discount as Wall Street and other institutional investors stay away from it. For example, a company with toxic waste or mafia involvement rumor may be an excellent opportunity. 7. There's something depressing about it. The mortuary business is a good example. If there's anything Wall Street would rather ignore besides toxic waste, it's mortality. 8. It's a no-growth industry. That's where the biggest winners are developed. In a no-growth industry, especially one that's boring and upsets people, there's no problem with competition. You don't have to protect your flanks from potential rivals because nobody else is going to be interested. That gives you the leeway to continue to grow, to gain market share. There's nothing thrilling about the thrilling high-growth industry, except watching the stocks go down. Carpets in the 1950s, electronics in the 1960s, computers in the 1980s were all exciting high-growth industries in which numerous major and minor companies unerringly failed to prosper for long. 9. It's got niche. Always look for niches. The perfect company would have to have one. Drug companies and chemical companies have niches, products that no one else is allowed to make. Chemical companies have niches in pesticides and herbicides. It's not any easier to get a poison approved than it is to get a cure approved. Brand names such as Robitussin or Tylenol, Coca-Cola or Marlboro are almost as good as niches. It costs a fortune to develop public confidence in a soft drink or a cough medicine. The whole process takes years. 10. People have to keep buying it. I'd rather invest in a company that makes drugs, soft drinks, razor blades, or cigarettes than in a company that makes toys. In the toy industry, somebody can make a wonderful doll that every child has to have, but every child gets only one each. Why take chances on fickle purchases when there's so much steady business around? 11. It's a user of technology. Instead of investing in computer companies that struggle to survive in an endless price war, why not invest in a company that benefits from the price war? Instead of investing in a company that makes automatic scanners, why not invest in the supermarkets that install the scanners? If a scanner helps a supermarket company cut costs just 3%, that alone might double the company's earnings. 12. The insiders are buyers. There's no better tip-off to the probable success of a stock than that people in the company are putting their own money into it. When management owns stock, then rewarding the shareholders becomes a first priority, whereas when management simply collects a paycheck, then increasing salaries become a first priority. There's only one reason that insiders buy. They think the stock price is undervalued and will eventually go up. 13. The company is buying back shares. Buying back shares is the simplest and best way a company can reward its investors. If a company has faith in its own future, then why shouldn't it invest in itself, just as the shareholders do? When stock is bought in by the company, it is taken out of circulation, therefore shrinking the number of outstanding shares. This can have a magical effect on earnings per share, which in turn has a magical effect on the stock price. If a company buys back half its shares and its overall earnings stay the same, the earnings per share have just doubled. Few companies could get the kind of result by cutting costs or selling more widgets. Chapter 9. Stock side avoid. Hottest stock in the hottest industry. This is the stock everyone gets to hear about. Hot stocks go up fast, but when price falls, it falls steeply too. Most people buy because others are buying it with a hope that the price will rise sharply soon. Avoid diversification. Value for shareholders is lost when the company overpays for acquisitions, and when the acquisitions are completely beyond their realm of understanding. In most cases, buying back shares or raising dividends is a better option than acquisitions. The trick is to find the right acquisitions in related business and manage successfully. Beware the whisper stock. From time to time, people will tell you about a company that they think is a great investment opportunity. Most likely, they have been telling about this company to every other person. Those are whisper stock with a hypnotic effect and a psychological appeal. Beware the middleman. The company that sells 25 to 50% of its wares to a single customer is in a precarious situation. If the loss of one customer would be catastrophic to a supplier, I'd be wary of investing in the supplier. Beware the stock with the exciting name. As often as a dull name in a good company keeps early buyers away, a flashy name in a mediocre company attracts investors and gives them a false sense of security. As long as it has advanced, leading, micro, or something with an X in it, or it's a mystifying acronym, people will fall in love with it. Chapter 10. Earnings, Earnings, Earnings. What makes a company valuable and why it will be more valuable tomorrow is earnings and assets, especially earnings. Sometimes it takes years for the stock price to catch up to a company's value, but sooner or later value always wins. When you analyze a company on the basis of earnings and assets, it is no different from buying an apartment, drugstore, or McDonald's franchise. It is important to remember that a share of stock is part ownership, not lottery ticket. The net asset is the book value after subtracting all liabilities from the asset. But if the company is not liquidated and sold off to the creditors, the value of the company comes from its assets' capacity to earn income. The next step is to put company into the 6 categories discussed in the chapter number 7. Slow grower, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. The success rate of fast growers is higher than stalwarts. But if and when the fast grower succeeds, it boosts its income by a huge margin. When you buy a stock in a fast-growing company, you're really betting on its chances to earn more money in the future. And when earnings are up, stock price is up. P/E ratio. Relationship between the stock price and the earnings of the company. Useful measure of whether any stock is overpriced, fairly priced, or underpriced relative to a company's money-making potential. Calculated as current price/earnings per share for the prior 12 months or fiscal year. Can be thought of the number of years it will take the company to earn back the amount of your initial investment. A ratio of 10 means the original investment will be earned back in 10 years. P/E level tend to be lowest for the slow growers and highest for the fast growers. First step could be to look at P/E ratios of various stocks you own or looking to own are low, high, or average relative to the industry norms. Before you buy a stock, you might want to track its P/E ratio back through several years to get a sense of its normal levels. If you buy Coca-Cola, for instance, it's useful to know whether what you're paying for the earnings is in line with what others have paid for the earnings in the past. The P/E ratio can tell you that. If you remember nothing else about P/E ratios, remember to avoid stocks with excessively high ones. You'll save yourself a lot of grief and a lot of money if you do. With few exceptions, an extremely high P/E ratio is a handicap to a stock, in the same way that extra weight in the saddle is a handicap to a racehorse. A company with a high P/E must have incredible earnings growth to justify the high price that's been put on the stock. Future earnings. The best way is the educated guess based on current earnings. You need to try and project what's going to happen to earnings in the next month, the next year, or the next decade. Earnings are supposed to grow, and every stock price carries with it a built-in growth assumption. If you can't predict future earnings, at least you can find out how a company plans to increase its earnings. Then you can check periodically to see if the plans are working out. There are 5 basic ways a company can increase earnings: reduce cost, raise prices, expand into new markets, sell more of its products in the old markets or to old/existing customers, or revitalize, close, or otherwise dispose of a losing operation. Chapter 11. The 2-minute drill. First step is to know whether you're dealing with a fast grower, a slow grower, a stalwart, a cyclical, a turnaround, or an asset play. And the P/E ratio has given you a rough idea of whether the stock, as currently priced, is undervalued or overvalued. The next step is to learn as much as possible about the company and what it is going to do to bring about the added prosperity. This is known as the story. Before you buy a stock, you should be able to give a 2-minute monologue that covers the reasons you are interested in it, what has to happen for the company to succeed, and the pitfalls that stand in its path. Here are some examples of 2-minute monologue. Slow grower. Focus on dividend. This company has increased earnings every year for the last 10. It offers an attractive yield. It's never reduced or suspended a dividend. And in fact, it's raised the dividend during good times and bad, including the last 3 recessions. It's a telephone utility, and the new cellular operations may add a substantial kicker to the growth rate. Cyclical. Focus on business conditions, inventories, and prices. There's been a 3-year business slump in the auto industry, but this year things have turned around. I know that because car sales are up across the board for the first time in recent memory. I noticed that GM's new models are selling well. In the last 18 months, the company has closed 5 inefficient plants, cut 20% off labor costs, and earnings are about to turn sharply higher. Asset play. Focus on assets and how much they're worth. The stock sells for $8, but the video cassette division alone is worth $4 a share, and the real estate is worth $7. That's a bargain in itself, and I'm getting the rest of the company for -$3. Insiders are buying, and the company has steady earnings, and there's no debt to speak of. Turnaround. Focus on how has the company gone about improving its fortunes, and is the plan working so far? General Mills has made great progress in curing its diversification. It's gone from 11 basic businesses to 2. By selling off Eddie Bauer, Talbot's, etc., and getting top dollar for these excellent companies, General Mills has returned to doing what it does best: restaurants and packaged foods. The company has been buying back millions of its shares. The seafood subsidiary, Gorton's, has grown from 7% of the seafood market to 25%. They're coming out with low-cal yogurt, no-cholesterol Bisquick, and microwave brownies. Earnings are up sharply. Stalwart. Focus on P/E ratio and whether the stock has had a dramatic run-up in price in recent months, and what, if anything, is happening to accelerate growth rate. Coca-Cola is selling at the low end of its P/E range. The stock hasn't gone anywhere for 2 years. The company has improved itself in several ways. It sold half its interest in Columbia Pictures to the public. Diet drinks have sped up the growth rate dramatically. Last year, the Japanese drank 36% more Cokes than they did the year before. The Spanish upped their consumption by 26%. That's phenomenal progress. Foreign sales are excellent in general. Through a separate stock offering, Coca-Cola Enterprises, the company has bought out many of its independent regional distributors. Now the company has better control over distribution and domestic sales. Because of these factors, Coca-Cola may do better than people think. Fast grower. Focus on where and how it plans to continue to grow fast. La Quina is a motel chain that started out in Texas. It was very profitable there. The company successfully duplicated its successful formula in Arkansas and Louisiana. Last year, it added 20% more motel units than the year before. Earnings have increased every quarter. The company plans rapid future expansion. The debt is not excessive. Motels are a low-growth industry and very competitive, but La Quina has found something of a niche. It has a long way to go before it has saturated the market. The more you know, the better. In many cases, you need to devote several hours to developing a script. Chapter 12. Getting the facts. Rumors are usually more exciting, but as an investor, you need to focus on getting the facts. Annual reports and quarterly reports are the best resource for facts. What you can't get from the annual report, you can get by asking your broker, by calling the company, by visiting the company, or by doing some grassroots research, also known as kicking the tires. Getting the most out of a broker. If your broker recommends a stock, as your broker about a category of stock, fast grower, slow grower, stalwarts, cyclical, turnaround, asset play, recent growth in earnings, P/E ratio relative to historic levels, expansion plans, debt situation, insider buy, buying back share, etc. Calling the company. If you have specific questions, the Investor Relations Office is a good place to get the answers. Before you call, prepare your questions. All you're trying to do is to get a reaction to whatever script